Good afternoon, webinees. This is Paul Rickard from the Switzer Superport, and welcome to our July webinar. With me this afternoon is James Dunn. James is the founding editor of Shares magazine, also the author of numerous books, including Share Investing for Dummies. So James hopefully will be able to cast a lot of information around some of your questions around the share market and others. So thanks for joining us. As usual, we'll make sure this finishes by no later than 1:30 Sydney time. So I know a lot of you have things to go to, and so you can plan your diaries. Now, before I start, as you can see on the screen in front of you, I do need just to be cognizant of the general advice warning. Of course, we know nothing about your particular financial circumstances or need, and so the information we're going to talk about today is, of course, general in nature. It's not particular or personal to you, so if you've got any questions about it, then as always, we encourage you to seek appropriate professional advice. And just a few housekeeping matters before I get the presentation underway. Please close all applications and programs that are not in use. Please ensure the volume on your computer or speakers is turned up to a comfortable level. And of course, during this webinar, you can send in questions during the webinar via the questions box if you're a first timer. That should be towards the sort of the bottom right-hand corner of your screen. Send in your question there, and then when it's your turn, we'll come to you. If you do have a microphone and we can unmute you, we'll actually get you to ask your question. If you don't have those facilities, then we'll read out the question for you. So we'll come to your questions very quickly. Just to sort of start the webinar off, I'd like to pick up on a couple of things. Firstly, just a quick review of the market back in June, and then also, given that June only finished 3 days ago, but so much seems to have changed in 3 days, particularly with the US employment data, so we might just talk about where the market is heading. But let's have a look back on June, and as you can see in front of you, we've got the S&P ASX 200 performance for June and the accumulation index of minus 1.5%. On a year-to-date basis, that's since the 1st of January, the market's up 3%. And then we've got the various 11 sectors and their performance both for the month of June and on a year-to-date basis. So I might throw to you, James, welcome you to the webinar.
And good afternoon, Paul. Thank you.
So James is joining us from Melbourne, and I think if you're looking at your screen, we get a very interesting backdrop to you, James, which looks great. And
extremely windy, Paul.
Look, I'm sitting in a studio in Sydney, and it's apart from the air conditioning, I don't have to put up with any other wind. So look, let's start with the market in June. How would you describe the market? What were the sort of the standouts for you?
Well, it was fairly weak. I mean, obviously we've got some good performers in the property trusts and the utilities, but I think the year-to-date figure is, well, slowly gathering some momentum, Paul, and obviously the earnings season is going to be very, very important for our market in August, September. It really is critical. Given obviously the lead from the United States, where we've got a record high on the Dow, that would imply that we've got a healthy global equity scenario to follow, because of course we follow the US most of all. But our market, well, June was a setback for most sectors, but it's just pushing forward.
Now, probably the standout for June was property trusts, and also on a year-to-date basis up 12.7%. There's certainly were the underperformers of 2013, but have been the performers of the first half of 2014. This is obviously as people are chasing yield. Do you think there's much left in that sector?
Well, I think the critical thing about the property trust sector is just how they've gone back to the future, Paul. They of course were about 7 or 8 years ago. They were extremely simple vehicles that just captured the rental inflow from the tenants in their properties, and they passed that on to the unit holders. And then of course in the pre-GFC, in the glory days prior to 2007, they geared up, they bought property overseas, they added other earning streams to their bow, things like property development and funds management, etc., etc. But all of those things made them much more volatile, and we had that quite horrible experience for property trust investors in the GFC when they collapsed, and investors realised that they were no longer just stodgy, boring, yield-generating vehicles. They were highly entrepreneurial, most of them, and they'd added in much too much equity risk. They've shed all of that. They've got back to what they should be, delivering just, they've de-geared, strengthened their balance sheets through equity issues, equity raisings, etc. They have got back to what they're supposed to be, and they're doing that yield generation job quite well. And if you look at, well, it's been a sector with a lot of corporate activity in it recently, and obviously Westfield's been a massive, massive part of that. But I think that's the big story of the property trusts, or as they are now known, real estate investment trusts. They have returned to being very solid, predictable, boring generators of yield.
Which is all good for many investors.
Absolutely.
And there's nothing wrong with that at all, is there?
No, that's right. And the thing about the property trusts is that if you look at it, it's quite a good sector now in terms of what it offers you. There's exposures to industrial, there's commercial, there's retail. We've even got some specialised ones now that healthcare REITs, ones that own data centres, ones that own storage centres. So it's an interesting sector, and one that you can really tailor the exposures that you want, Paul, to various sectors of property, or go with the bigger diversified ones. So you can put together, with a bit of research, you can put together a real estate investment trust portfolio that covers some different areas of the economy, and you can have it quite well diversified.
Okay. Look, I think the other thing that's still interesting about on a year-to-date basis is that by and large it's still the yield sectors that are driving the market higher. That's not wholly true, but with consumer staples probably the odd one out there, but we're certainly, in terms of financials, which have of course the biggest sector with the major banks, still outperforming despite some of the doom and gloom out there about the banks. And certainly we've seen that in property trusts and utilities. So that was the first 6 months. I think the whole world seems to have changed a little bit in the last 3 days since we've had the US employment data in particular, but some great figures out of the States. So we're heading up to 5,600 now. Is that where you think we're up to?
Well, I think so. If we can get a good earnings season in the full year season in August, we shouldn't have any rude surprises from here on. Companies have had more than enough chance to alter their guidance, Paul. Quite a lot of them have done that, but we know now that situations can change in a couple of months, but companies really should have foreshadowed any bad news ahead of this June 30 full year earnings season. We do know that if companies, what the share market hates most of all these days is to be surprised with bad news. It likes being surprised with good news, but any bad news really should be in the market by now, or in earnings season, companies that report in a manner that the market's not expecting, Paul, as we know now, they really take a drubbing. There can be some very, very large share price falls on any one day. 10, 15% is not uncommon for companies that disappoint the stock market. So we're hoping all of that is out there already in guidance and the confession season, and that we have a good, solid earnings season, because for share prices to rise further, the earnings really does have to come to the party, and everyone, I think, is expecting a reasonably strong performance in this June 30 full year season.
And what about on the materials, or the so-called, let's talk about the leading resource stocks, BHP and Rio? They've really been the standouts this week. BHP, I think, is up more than 5% this week. So on the back of increased confidence about China and other markets. Are you a believer in that story, or is this just they got oversold and this is perhaps just the correction because they went down too fast, too quickly?
Yeah, a bit of that, a bit of being oversold and rebounding a bit. But we saw, look, China, as we know, is slowing its economy. There was some good news from the services sector this week, Paul, that shows that the broader Chinese economy does appear to be steadying on the back of government stimulus. Look, it's still got very steel-intensive infrastructure spending going on. They're adding 7,000 kilometres of rail in this calendar year. So we know that the Chinese economy is slowing. We know that the double-digit growth rates of 5 to 10 years ago aren't going to be repeated, but that's what we expected. Everyone wanted and acknowledged that China was going to move to being a more slow growth rate economy as it became more of a domestic spending-oriented economy. So I think BHP and Rio are still, these days, of course, if we say that 10% Chinese growth, those days are gone. Well, so have the days of $150, $160 a tonne for iron ore. And we're wondering now, where is it going to end up? It's currently below $100. There's all sorts of opinions in the market, Paul, about whether it will settle down at 95, 90, 100, whatever. The thing is that BHP and Rio Tinto are still expanding their supply quite hugely. And for them, it's now a volume story rather than a price story. They make lots of money at these iron ore prices. They're producing iron ore, mining the stuff for less than $50 a tonne. So still at 90, 95, 100, it's still profitable for them. Fortescue, not quite as cheap a producer as they are. Everyone's expanding their supply. We knew the iron ore price was going to come down on the back of that. Australia is pumping out much more of the stuff. Our big miners are still very profitable at these iron ore prices. Should make the point, though, Paul, that Rio Tinto these days is almost 90% of its earnings is iron ore. BHP is a little bit less than that, somewhere around 70, 75%. So Rio Tinto, we still call them the big global bulk diversified miners, but Rio Tinto is less diversified these days than BHP is.
Yeah, I certainly prefer BHP for that diversification reason. And I think if you look in the last 6 months, it's done a lot better than Rio has. But it's interesting to note that as a BHP up over 5% this week, so it just shows you how quickly things can change. Let's move on to some of the questions.
Well, we should just point out, Paul, one interesting story that came out this week, that BHP shipped its 1 billionth tonne of iron ore to Japan. Over 47 years they've been doing that. That amount of iron ore could make railway rails equivalent to going around the world 155 times. It's an absolutely massive amount of commodity raw material they've shipped to Japan, and the point is that they're relatively new to shipping it to China, but this will happen with China as well. It'll be a very, very long-term relationship, and the earnings that flow over that relationship will be very, very substantial.
Okay, let's move on to a couple of questions. We had some come in beforehand, so before I get to your questions on the line, we'll take these. This is from Chervanez, asking about investment in global shares. Really, how to pick the right managed fund, I think, is probably the question, and also about Magellan Global Fund. James, do you want to sort of just comment around that question first of all?
Yes, well, look, Magellan Global Fund, it's a very good fund. Hamish Douglas is a very astute stock picker. They have, Paul, been very, and Chervanez, they've been very big on this theory that you can get really good exposure to China through the global brand names that Chinese consumers, as they become more wealthy, will buy. So the same sort of drivers, luxury goods and consumer items, that the same kinds of stocks that have been very, very strong on the back of Western consumption will also in time become very strong on the back of Chinese consumption. So that's been the theme that they've played, particularly in food and consumer goods, things like Nestle and Unilever and Procter & Gamble, those global mega cap companies that make consumer goods. Magellan have been very big on this theory of that's a great way to play China, because you're not so much buying Chinese stocks, but you're buying global stocks that sell a lot in China. And not only sell a lot in China, they sell stuff that Chinese consumers aspire to buy. There's a variety of themes at work there. Chinese people becoming more wealthy and going up the GDP per capita scale, and as they do that, they go up the protein scale as well, and they start to eat better. So Magellan has played that theme that way. Others are doing it through luxury goods, etc., etc. So I think Magellan Global Fund has been a very good performer. It's lagging its benchmark index this year, but it's been very strong over the 5 years and 3 years. It's outperformed its index quite strongly. So I think Magellan Global Fund is a very good fund, and it's well managed, and it's a theme that is you can understand and relate to. I like the idea of global shares. I think Australians obviously have to have some level of overseas diversification, whether you do it through a managed fund or buy the stocks yourself. There's nothing stopping anybody from buying the global stocks that we all know, the brands that we use and are very familiar with. There's nothing stopping anyone from buying those shares, particularly those US global mega caps, Srinivas, that are global stocks really. They happen to be domiciled in the United States, but they're not US stocks anymore. The massive stocks, Apple and all of those big Dow stocks, the Dow Jones constituents, they are global mega caps. And you do take currency risk when you buy them, but a lot of people don't mind having that. They actually view that as another layer of diversification. So I'm a big advocate of investment in global shares, whether you do it through a fund, an actively managed fund like Magellan Global, or through an exchange-traded fund, or through buying stocks yourself. I think it's a good thing to do.
Okay. Look, I'll share those comments, Shervinez. I think Magellan's pretty good. I probably, if you're looking at funds, I wouldn't stick with one. I'm always a believer that you want to diversify and take away some of the manager risk. I'd probably look at Platinum as well, and a couple of others in that category. We might also go to Robert, who's got a question on purchasing international shares. If we can unmute Robert Bernadette.
Robert Bauer, are you there, about international shares? Okay, it appears Robert's not there, but he's asked a question: how can we purchase international shares?
Okay, look, I might answer that one for you, Robert. There's probably the easiest way is to go through one of the major brokers, CommSec or E-Trade. Both offer pretty easy facilities to buy international shares. That's if you're buying the shares directly. Look, there's a few traps here. You've got to pay potentially a custody fee, and as most of the shares will probably be listed in the US, you've probably got to fill in what's called a W8 Ben form. Bit of a pain in the neck, but that goes to the Inland Revenue in the US. So if you were buying shares directly, I'd probably contact either CommSec or E-Trade. If you're not after owning the shares directly, but alternatively things like an ETF, then look at ETFs such as IVV, which is the big one from State Street, or the Spider people.
BlackRock and the iShares as well.
Yeah, BlackRock on the iShares, I should say. Yeah, sorry, James. And that covers the S&P 500. So look, you've got three ways to buy it, to get it set internationally. You buy a managed fund, which is Magellan, Platinum, and some of you sort of in that category. You buy an ETF, and there are a number of ETFs that iShares and some of the other ETF providers have, or thirdly you can buy the shares directly on the market through one of the brokers. Okay, so let's move on to another question I've got here. Maybe I'll pick up this one, James. And this is really a slightly technical question from Brian around his self-managed superannuation fund and this year's pension payment. So three parts of the question, all relating to June 30 type issues. First of all, for a managed fund, do I use the net asset value entry or the exit price as a close of business on the 30th of June? Most auditors would advise you to use the net asset value. So the rule from the ATO is you value things at market, and market value would, in most 9 out of 10 occasions, would be deemed to be the NAV. So that's the valuation price. Secondly, do I have to include cash in my broker account? Well, the answer is yes. You should be including all your assets in the valuation of your superannuation fund. And then are there any other issues to be aware of when valuing a portfolio for the purpose of calculating a pension? In other words, the pension is based on the starting value as at the 1st of July. Look, the main issue is, again, that the tax office expects things to be valued at market. That's very easy for a share or a managed fund where you can get, there are listed prices or the prices are identifiable. For an unlisted asset or an asset that might be a little bit exotic, then you may need to either get a professional valuer to give you that valuation. For property, you might need to get an estate agent potentially to give you a valuation, and that's the sort of thing to do. So if the asset's listed, it's really easy to determine the market value. If it's unlisted, then you might need some external help, including getting a valuation in place. Okay, so hopefully, Brian, that answers your question. And then the third question we had, which I think is interesting in terms of James, is from Michelle regarding VSO, or it's a Vanguard ETF that covers sort of the small caps. It does bring into some of the issues around the small cap part of the market, and in some ways the rather disappointing performance of the smaller capital stocks over the last 12 to 24 months. Do you want to have a go at answering Michelle's question, James?
Well, Vanguard, the VSO, Michelle, an exchange-traded fund, just to give you exposure to those small companies. You just get the index. Vanguard uses the MSCI index, which is an index which tracks Australian small companies and their performance. So, look, it hasn't done too badly over the last 12 months. It's up 17.2%, but on a 3-year basis, and we don't have 5-year figures for this particular ETF, but on a 3-year basis, it's up 0.6% of a year. 0.6% a year. So hasn't been a good performer on a 3-year basis. And I think with Australian small caps, they're riskier than the Australian share market in general. They have some very good constituents, and they can. This sector of the market can do well in various periods, but it can do poorly in various periods as well. There's been, look, I think in the Australian market we've seen quite a lot of. It's a concentrated market at the best of times. Most of the investment is in the top 10, but yield-driven investment, Michelle, has really been a problem for the Australian share market, in that those big yield-generating stocks, being the big 4 banks, Woolworths, Telstra, etc., they have really grabbed the lion's share of investment, and that's largely to do with this unforeseen growth of self-managed super funds. Nobody ever expected self-managed super funds to be as big as they are, but they are as big as they are now, and they want yield, and so they've gone in for those top yielding stocks, and that has really caused some underperformance from the small companies index. It's a good diversifier to have in the portfolio over long periods of time, but as you can see, the last 3 years it hasn't done a great deal. So I'd stick with the small companies as a portfolio diversifier.
Look, I think there's I agree with the thought about investing in small companies as a diversifier. I probably have a slightly different view, James. I'm also invested in one of the ETFs that does that, which is the ISO, which actually tracks what's called the Small Ordinaries Index, which is companies numbered 101 to 300. And that's been pretty disappointing, and I'd have to say that I think when it comes to micro caps or smaller caps, that's maybe an area where a fund manager can add value, because you know, what they largely play off is there's much less information in the market, and so fund managers who have, you know, expertise and analysts can potentially add more value where there's less transparency than they can, I think, in the top 10 or 20 stocks.
Oh, I would agree wholeheartedly with that, and that's one of those great areas of the market where you can find active managers, Ausbil, Novaport, etc., Small Co Investment, Ironbark, those kinds of fiducian Australian smaller companies, those kinds of active managers that they are able to add value. And so having the exposure in your portfolio, which is a good idea, there's a variety of ways to do it. And active, I think I agree wholeheartedly with Paul, active managers do show the ability to add value on top of the index in this particular category.
Yep, so that's where I'd probably look at it. And again, I wouldn't go for one, because you know, the whole thing about diversification is you spread some of your manager risk. So I'd look at 2 or 3 and probably do it that way rather than through ETFs. So ETFs make sense, I think, at the top end of the market, as does direct investment. Smaller, you know, less liquid companies, you can say there's value from a manager. So that's some thoughts there. Okay, let's move on to some more questions. We've done the questions we got in earlier. So we've got a question from Lindsay Hunt about Ramsey Hill.
Lindsay, I've unmuted you. Are you there to ask one of your questions?
Yeah,
Can you hear me?
Yep, I can hear you loud and clear. Go ahead.
Yeah, I watch the Switzer report regularly on ATV on channel 602, and Rudy Van, I can't pronounce his last name, he said here a while back, just keep with Ramsey Hill, no matter what price they give, he said just keep buying them. He felt they're a very safe and good buy, but that they sort of haven't performed real well the last 3 months, I know, 2 or 3 months, and I'm just a bit concerned. Where do you think they'll end up, or where will they go?
Look, I'll give you some comments. It's a company I know really well. Look, they are one of the best managed companies in Australia. They are trading on a very high PE multiple, and that's sort of the downside. So it's about 27, 28 is the forward multiple. I think they've done okay over the last 3 months, but look, my guess at the moment is they're partly affected by two things. One, they've just announced an acquisition in France, and so that's being digested. And secondly, we have the HealthScope IPO coming out, which we'll read about next week. Now, it's basically being priced like a Ramsey lookalike, and you know, it's going to, one of its pitches is that whereas Ramsey's trading on a price-earnings model of about 27, 28, HealthScope will come to the market at a price-earnings model of about 20 to 22. And it's you know, it's going to be a more attractively priced business than Ramsey. So I guess what you're seeing a little bit of Ramsey is a bit of selling ahead of that that IPO, and potentially a few people looking to switch into HealthScope. So that's sort of one of the factors. My gut view is that HealthScope's got a long way to do to prove itself equal to Ramsey, and I agree with Rudy. I wouldn't be selling Ramsey, but you know, they're an expensive stock, so that's the thing to sort of bear in mind. James, what are your thoughts on Ramsey?
I'm pretty much concurring with you, Paul, that they're very, very well managed. And look, this is the problem with these kinds of stocks. When they go really well for so long, and look, Ramsey's returned in total return, capital growth plus dividends, 36% a year for 5 years. So it's been a fabulous performer for for shareholders. Now, yes, it is pushed slightly into overvalued territory, because that's what happens when companies that grow the way that they do. Look, the analysts' consensus is still somewhere around $48 as a target price. It's $46.21 at the moment, so there's a little bit of room to go. Its revenue growth, earnings per share growth has been really strong, but companies find it difficult to keep those kinds of growth rates going for so long, and it has been a very, very good performer. But yes, hasn't done much in the last few months, but it's done well over recent years.
Just trying to get you the 5-year chart up. Just go for the 5-year, Bernadette, because that'll just show you. If I showed you a 10-year chart on Ramsey, it looks even better. There are not too many companies in the market. Commonwealth Bank is about the other exception that have a share price chart like that. And that's why people put so much faith in the management and the board. So, yeah, that's why it's priced the multiple of 28 where it is at the moment. And of course, it's got, you know, big feet to fill to keep going, but I think there's no reason why I'd be selling it. Would I be buying maybe at these levels? Maybe not, but you know, I think that don't get sucked into the HealthScope one also, because they say they're like Ramsey. They haven't yet proved themselves, would be my advice on that one. So I'll be talking more about that during the week. Have you had a look at the HealthScope float yet, James?
Look, talking about that recently with funny, these floats coming out of private equity, Paul, they still have a perception in the marketplace that private equity is greedy, because of course that's its exit. When they sell the stocks onto the stock market, they're getting out of it. But I think too many people still think of Myer and think that Myer has never traded at anywhere near the price at which it was sold by the private equity people. But other things like JB Hi-Fi and Seek, etc., they've done pretty well. And HealthScope coming back onto the market, because I believe it was listed, it'll be a completely different beast. It'll do well, but I think, as you point out, it's being priced to piggyback on Ramsey, which it may not be an apples for apples comparison. The other point we should make about Ramsey is it's not a great dividend yield stock, but certainly in terms of you can't argue with 36% a year over the past 5 years in terms of investor return. If you want more than that, you're getting greedy.
Okay, let's move on to a question from Matt on Zero. And let's just see if we can unmute you, Matt. If not,
Matt, you're unmuted. Do you want to go ahead and ask your question, Matt Merlihan?
okay. Well, I can't bring up the stock quote, but there's a question about Xero from Matt, which says, do you think Xero will recover to their highest point of around $42? I'm going to start that one with you, James.
Well, Xero, I think it is aptly named in terms of its profit, isn't it, Paul?
About that.
I don't think it has yet turned a profit. It is valued on the market at $3.1 billion. So massive market capitalisation for a company that has not made a profit. Look, it's certainly in business building mode. It's coming out of New Zealand, not the New Zealanders, but nobody would have expected a globally dominant platform for online accounting and business services to come out of New Zealand, but it certainly has, and it's a very well-regarded stock in that field. Maybe it could tweak its business model when it liked and start turning a profit. At some point it will have to, but the fact of the matter is that it does not make a profit at the moment. And it's achieved 100 million New Zealand dollars a year in revenue, so it's not insubstantial, but boy, $3.1 billion as a market capitalisation. We got used to that back in 1999, 2000. Companies that didn't make a profit grew to big valuations. We haven't seen the like of that since those days. Xero went to, yes, above $40, but back around $24.45 at the moment. And look, it's got to settle somewhere when it creates some profit. That's really, it's very hard to value this stock, literally very hard to value it.
It is indeed, and Matt, if I owned Xero at $42, I wouldn't own them. So I think my answer is no. I think the market got way over the top of itself there. Look, it's a very interesting company, lots of fans, spending lots of money marketing, but you know, it's just got way ahead of itself up near there, and I think you're going to struggle to see that get back through $30 in the short term. Okay, so we've got just do I do those comments? Just talk to my. Okay, so done that. Do you hear? Question from Russell about it would like to increase government.
Russell Walton, are you there? Russell Walton, are you there? Russell, testing, are you there? Russell, testing.
Okay, so I think. All right, I think I've got. I can answer. I can read Russell's questions. Is do you think it's likely the government will increase the age at which people can access their super? My answer to that question, Russell, is yes. At the moment, they've announced the increases in the pension age, which will go up to 70 by 2033. They haven't touched the preservation age, which is still, for most people, 60, or it's 55 going up to 60. And I think it's logical at some stage, either post the financial systems inquiry, or as a budgetary item in the next budget, they'll increase the preservation age from 60 up to 65. They will certainly give people notice. So look at, as I said, we've been in a transition from 55 to 60 for the best part of a decade, and just like the pension age to 70 doesn't take effect to 2033, an increase in the preservation age from 60 to either 62 or 65 will be phased in over many, many years. Okay, so let's go to Wendy. This is a question about Amcom.
Wendy Wells, I've just unmuted you. Are you there? Okay, so Wendy has asked the question, can you give your thoughts on the future prospects of Amcom, as their performance has been quite strong as of late?
James, I might throw that one to you if you've got any thoughts on Amcom.
Another one that has been a good performer on 3 and 5 year bases, but not so good in the last 12 months. So only up 1.8% in the last 12 months. It's gone sideways, but it has According to Stock Doctor, it's performed 40% a year for 3 years and 49% a year over 5 years to investors. It's fantastic stuff. And return on assets of about 13.5%, return on equity of 25.3%. Really good stock. It just had an equity raising last month. Still, the analysts that follow the stock, the consensus price target is about $2.29, and the stock is under $2 at about $1.96. So quite a bit of room for further growth in profitability for Amcom investors. It's been a good stock, IT and telecommunications company. Just had a placement, so share price weakness. I would say disregard the last 12 months. It's still a fairly good prospect, this company. It's been a good performer, and I think it's poised to go higher. But as I say, the most recent 12 months has not been great. But there's clearly envisaged room for the stock price to rise on the part of the analysts that follow the stock most closely.
Okay, I don't know a lot about Amcom. I just note from FN Arena that the consensus target price is $2.13. That's a little bit higher than the current price, around $1.98. And yesterday, Macquarie downgraded it to neutral from outperform. So I'll just throw that in, but I'll leave the comment that you've made there, James. Okay. All right. So let's go to Hans. And you've got a question about Chinese growth.
Hans, are you there? Hans Knoll?
Okay, so I think Hans's question is China's growth is 7.2% and their economy will double in 7 years, which is about what happens when you grow at 7% a year, maybe a bit more. So why such a cautious outlook from everyone on China? Do you want to answer that one, James?
Yeah, look, it's a good point that we do get so caught up in worrying about the Chinese growth rate. Obviously it was double-digit 4 or 5 years ago. It's slowly come down. It's now 7.5, 7.2. People worrying about, will we see a 6 in the Chinese economic growth rate? And I think Hans has touched on a very good point that we shouldn't so much worry about the growth rate, because on the quantum of the Chinese economy, it's massive, massive upswing. Now they have planned to lower their growth rate from the far more volatile double-digit growth rate that was primarily driven by fixed asset investment and massive infrastructure spending, etc., etc. They're trying to become more driven by their domestic spending. So when you do that, you do sacrifice headline growth rates, and it does come down, and we all expected that. Look, if it fell to 5-point-something% quickly, that would be a bit of a worry. And there are worries about China, the housing market, etc., etc. The credit risk involved in the massive debt that's held by the municipalities and the provincial governments, and ultimately Beijing's on the hook for all of that. And so we really don't know the extent of the debt problem in China, but the quantum of economic growth that is suggested by a 7% growth rate, even a 6% growth rate, on the size of the already existing economy is massive economic growth, and we shouldn't forget that. So I don't think the China driver of the global economy is going to go away anytime soon.
Okay, so let's go to, is it Burke? About a question about Crown. And,
Bert Crosby, are you there?
Can you hear me?
Yep, you're loud and clear. Ask away.
Yes, just like to ask Paul a question on QBE and Crown at the current prices, please, as a short to medium term trade.
Okay, look, Crown's had a pretty good week. It's up about $15.90. I think the bit of weakness we saw in Crown in June was on the back of some reports around what was happening in Macau and smoking bans and a few other things. I think Crown is still well positioned for a pick-up in that market, and that's a great place to be investing. Australia, look, it runs the best casino in Victoria, and it's going to benefit long term from what's happening at Barangaroo. So I think you've got Crown as a stock to hold in your portfolio. providing you're okay ethically with it for the long term. And certainly in the low $15, it was good value. James, you want to comment on Crown?
Not so much on Crown. I was pretty keen to comment on QBE, which I think has been punished for a very poor result in 2013, and QBE uses the calendar year as the financial year. So it got clobbered because of a perceived poor result in 2013, but clobbered to the point of massively undervalued. So at levels at around $11, QBE, which that's down 28.2% in total return in the past 12 months, and it's struggled over the 3 years, struggled over 5 years, but at $11.06, which is the current share price, it is quite hugely undervalued on the analyst consensus. They're expecting that there's a valuation somewhere around $14.60 for that stock. That's the target expectations for analysts. So justifiably punished, this stock, but it's stayed there a bit too long and is looking clearly undervalued.
It's up almost 4% today, James. I don't know if you've seen that,
No.
which I guess is probably in the back of a movement higher in US interest rates, at least long bond rates. I mean, I got out of QB. I got a bit impatient with it. I'm a bit look. QB, I think, was always going to benefit from two things: one, a falling Australian dollar, and two, higher US interest rates. Now, the cycle seems to not, wouldn't say it's turned, but in the last 24 hours we've seen two things happen. One, we've seen much stronger employment figures in the US, and so that started to push US interest rates up again, at least in the long bond rates. And secondly, some concern here with the Reserve Bank now starting to positively jawbone the dollar down. So Crown will benefit, QB will benefit from both those things. But you know, I'm out of QBE, and I'm not I lost patience on QBE. So I don't disagree it was undervalued, but sometimes stocks can be undervalued for a long, long time.
And for good reason.
And for good reason. And I think QBE is going to take a little bit of a little while to sort of regain market confidence. But you know, 4% today is a big move, and I don't know whether there's an upgrade somewhere in the market, but I suspect it's probably just, you know, there's been a big change to the last 3 days. We shouldn't underestimate what's happened in the last 3 days on our markets. So let me move on. We've got a comment here from Dunn Robert's question. What was this one? Heather? Okay, so you want to see if we can get Heather unmuted?
Heather Lazar, are you there? Okay, so Heather has asked, or has said rather, utilities have performed very well over the past year. What utility stock would you recommend on the ASX?
James, I'll throw that one to you.
Look, the sector, as we were talking about, has been one of the, with property trusts, been one of the top performers. Look, that's difficult. I haven't looked at this sector for a while, but the utilities are a relatively new sector in our market, in the sense that we, to have had critical mass as a utility sector, we haven't always had that in our market. Look, at the moment, Paul, I wouldn't be comfortable pointing to one of them as a potential better performer than the others. But again, it's a sector that has been one of the better performers in our market. Obviously, it's got the swirling regulatory winds of electricity pricing, etc. So I'll just leave it at that. It's a good sector to have, good diversifier, but one that I haven't looked at the moment.
Look, the one I prefer is AGL, stock code AGK, of course, which confuses people a bit. The other one is Spark Infrastructure. As James says, both are subject to a bit of regulatory risk. You've got to be a bit careful about that. And look, I think there are actually some pretty good companies in that sector, but as long as you're cognizant that things happen all of a sudden by governments that can change the dynamics a little bit. So maybe it does sort of just as, you know, invest more at sector weight, but I'd be looking at probably AGK or Spark Infrastructure would be the two I'd suggest. I think we covered this a few editions back. I think Ron Bewley went through the sector. Okay, so Richard has got a question on Telstra.
Tim, we've just unmuted you. Are you there?
Yes, I have.
Yep. You can hear you loud and clear. Go ahead.
Hello.
Can you hear me?
Yes, I can hear you, Richard.
Yep. Is Telstra likely to announce a buyback in early August reporting session?
Now I lost you just when you were asking the
Okay.
question.
I think, Richard, there's not a lot of echo at your line. The question, I think, is Telstra likely to announce a buyback in August? James, you want to have a go at that?
Look, it's been mooted. I haven't seen anything on the official front with this. It's been reported this week. Could embark on a buyback. 2 billion is the mooted figure. It wouldn't surprise me, but we don't know yet.
Yeah, look, I probably comment. I didn't see the report. I think it's probably a little unlikely, but I think they're still under a little bit of pressure from the analysts to make sure their capital is sufficient. But you know, there's a capability there. I see no reason to sell Telstra. I just hope Telstra keeps on doing what it's doing, and that is it doesn't get too many crazy ideas to go and expand offshore.
No, this 7.8% grossed up yield, Paul, we were talking before about the stocks that have been the main recipient of yield-focused investment. Telstra's certainly been one of them.
Yeah, my major concern, James, about Telstra is hubris gets in the way, and they start to think they're a big international telco again.
Yes, or if they start wearing black turtleneck skivvies and talking about being, well, a global tech operator.
Yep, all those sort of things. That's when I'm out of Telstra. But until they do that, you just stay for the ride and enjoy the fully franked dividend. Okay, we might go back to Robert. Had a question about international bonds. Rob's microphone. Okay. Look, he says, how can we best buy international bonds? That's a pretty tricky one. Robert, the two easiest way to buy international bonds are through an international bond fund. And the second way, the way I wouldn't recommend, is you can get some ETFs. Now, the reason I'd stick with a fund is first of all, what you want in a bond fund is credit diversification and also a bit of yield curve management. And you don't get either of those necessarily so much in a index-based fund. Secondly, you can't buy bonds yourself because you won't get, you just don't have the capital to buy bonds in small parcels. So I'd be looking at a fund, and there's a couple of funds, lots of funds that will specialise in that. That's my view, James. Do you see it differently in terms of international bonds?
Oh, look, I think there's companies like FIG Securities that are opening up global corporate bonds to self-managed super fund investors and retail investors with a bit of money. How they've done that is to break down the parcels from the wholesale size to something like $50,000 minimums, and that at least enables some good quality global sovereign and corporate bonds to be a little bit more accessible to retail and self-managed super fund investors. But it is a difficult asset class to get into yourself, and so that's why the bond funds is what most people use.
Okay, we have a question from Peter about Syrah and graphite. Market, I must admit, I'm not an expert on, and I hope you know something about that, James. We'll go to Peter. See if we can unmute you, Peter.
Peter Laney, are you there?
I'm muted.
No, we can hear you loud and clear.
Okay.
Yeah, ask away.
Yes, I am interested in Syrah, especially that I'm suspicious that there are so many new companies coming on the market trying to mine carbon, graphite, and they're talking about all kind of nonsense. I just wonder whether it's a new bubble forming.
Well, Syrah has been a spectacular performer on the stock market in the last 12 months, up 122%. But look, the main project that everybody's excited about there in graphite, of course, which is a source of carbon, is the Balama graphite project in Mozambique. Look, long way from when in these kinds of situations, you've always got people talk about reserves and resources, and it does have a huge resource of graphite and vanadium, etc., etc. But in a country like Mozambique, people get excited about those kinds of deposits of all sorts of minerals around the world, but it's a long way from where we are now to mining that resource and making money out of it. So they've been a strong performer on speculation, but look, it's shot to $4.50. As I say, a long way from getting this stuff out of the ground and sold to customers and cash flow flowing through to the company and thus on to investors. So a very, very dangerous market to participate in. The time to buy this stock was 12 months ago.
Okay, thanks, James. It's not an area I know much about, so I'm going to leave that one alone. I've got a question here from Lyle about a Bentham wholesale syndicated loan. So we'll just go to see if we can unmute you, Lyle.
Hello.
Lyle, I can hear you loud and clear.
Yeah, great, thank you. Yeah, I've got a question, just looking at something different to a standard fixed income fund, looking at a syndicated loan fund, just looking at Bentham as one option, just thinking asking what are the risks of that sort of fund, please?
Okay, James, do you want to know much about this particular fund?
Well, the syndicated loan market, very, very deep market in the US. It is loans made to a company. The credit ratings are generally below investment grade, syndicated out to various lenders, and wholesale investors, big investors like the Bentham Fund can get access to that market, and lots of different industries the companies are in that are in this market. So very, very deep market in the United States as a company funding market, and investors that understand it can do reasonably well. It's higher yielding than other forms of fixed interest product, which means it's higher risk. But look, the Bentham crew are fairly savvy, I think, at Bentham Asset Management. Don't know much about the performance of this fund, the Wholesale Syndicated Loan Fund. They would say that, I mean, not just they in general, but they specifically, but people do talk about this kind of end of the fixed interest market as being a good diversifier in a portfolio, and I wouldn't disagree with that. But you've got to have a fairly large portfolio to be allocating to something like this, because it is almost an exotic area of the fixed interest market. But look, Bentham, good quality asset management firm. So not so up on the performance of this fund, but I would ask an advisor about this.
Okay, look, the only thing I'd say, I don't know much about the fund, Lyle, but I think James's advice is spot on. This is not something you do if you've got a small amount of money. There are still people around from 2008, 2009 trying to get money out of funds. And what tends to happen is when you invest more on the exotic end of the market is you need to be, they go well, and then sometimes, occasionally, some don't go so well. So I wouldn't be putting any into this that you need back quickly. I'd be small asset allocation only, that's under 5%, and it wouldn't be money that you need for liquidity purposes. As long as you're prepared to, that's probably your major risk with unlisted funds of this nature. Don't expect them to be liquid, particularly if things go a little haywire. So you've got to be patient, and that's why you get paid a higher return, because you're taking much more risk. Okay, let's go. We've got time for 2 more questions only, Bernadette. Dale's got a follow-up question on QB, which I think is a good one. Just trying to unmute your line, Dale.
Dale Wicks, are you there?
Yeah, thanks, guys. You commented that QBE analysts are suggesting 14.5. Currently it's 11 and a bit. What's going to change it?
I'll throw that one to you, James, first of all.
Well, I would think better results than they brought out in 2013. They were not good. It was a net loss after tax of somewhere around $250 million US. So while the people making the while the analysts putting their consensus target figure together comes to somewhere around, sorry, so the consensus figure of the analysts that follow QBE is more like about $13. So it's $2 short of that, and it really needs to get back into profit. So that is the bottom line with QBE. It needs, and look, insurance companies, and particularly QBE, it's a very esoteric way of arriving at an actual profit. It's not like a normal industrial to look at how the profit is derived, but it simply needs to report profits. That's the only way it's going to recover that share price.
I was just trying to get the 5-year chart up there, and sorry, I'm not technically very adequate, so apologies about that. Look, I'd answer exactly the same. What tends to happen with companies is they get it's almost like the 3 strikes policy, you're out. QB basically had 3 strikes in a row where it disappointed the market. So when the market gets disappointed, the analysts are made to look pretty stupid, which they were in the case of QBE. It does take a while to get back into the good light again, and companies don't recover quickly. So the best thing QB can do, as James said, it just needs to report profits, it needs to meet market expectations, and it probably won't get much of a re-rating until it actually gets on and does that. So it's got to really start to deliver on what it's told the market. And yeah, my caution on a stock like QB is it just will take a while for the market to re-rate it. Okay, one last question from Peter about Oil Search and Woodside. And the question, we'll just try to unmute you, Peter, if we can.
Peter Williams, are you there?
Yeah.
Yeah, we can hear you loud and clear. Go ahead.
Okay. My question is about Oil Search and Woodside Petroleum, and general outlook for oil and gas. And I'm trying to decide between which of those companies I should invest more in. I have some of the Woodside Petroleum shares, and I'm just thinking, should I add to them or add Oil Search or switch from Woodside Petroleum to Oil Search? What are your thoughts on that?
I'll throw that one to you, James, quickly.
Oh, again, I always like to look at, that's one of my favourite figures, what the analysts that follow the company think the stock can reach. And on those grounds, they still think the Oil Search is undervalued, but they're thinking that Woodside is quite fully valued. So you still got, well, something like 8% discount to analyst consensus price target for Oil Search, whereas Woodside has gone past its price target. Woodside obviously has had that recent being freed of that overhang of Shell's shareholding, so there's been a market reaction to that. They're both very good stocks in terms of their exposure to gas, and we all know that gas is coming into its own as a cleaner hydrocarbon fuel. Both very good prospects, but just on Woodside's probably run a bit further ahead than Oil Search has. Oil Search has got a bit to catch up. So on those grounds, just on the short term, Oil Search, it would imply that the analysts think there's more room for Oil Search's share price to rise.
Look, I wouldn't disagree, but look, I probably the comment I make about Woodside is it's now very focused on shareholder returns. I almost look at Woodside now as a dividend stock because we're going to see yields up there of 5 to 6% in the next couple of years from Woodside. So you almost start to think of Woodside as paying a dividend, as being almost a dividend style of play. What I think I don't like about Oil Search is Papua New Guinea. So that's just history. And so that's just got to take on a bit extra risk with Oil Search. I buy Woodside and think, look, they're not doing much. They're going to pay good dividend. They've got reasonably good tight controls and capital. It's almost becoming a bit like a utility play. Oil Search might have better upside, but it's also got more risk. That's probably the way I'd call it, James.
No, look, I wouldn't disagree either. That's a good call on P&G. Very big reserves, and Oil Search would say that they know that patch very, very well and can make good money out of it, and they may well be able to. But Woodside, now that I think it's not proceeding in the Middle East, Paul, the Leviathan project in the Eastern Mediterranean, they're not going to go ahead with that. More expansion projects closer to home and a bit more diversified.
Well, look, I'm going to call it a close here, James. Thank you very much for joining us today and allow you to take breath because because you've been fantastic on the phone there today, and also the insightful comments you've had about a number of those stocks. It's just after 1:30. I said we'd finish. I do like to make sure we run to time here. So thank you very much for joining us at Switzer for our webinar. We have these webinars on the first Friday of every month, so we'll be back again on the first Friday in August. I think it's the 1st of August from memory. And don't forget our report will be out, Peter's email will be out tomorrow morning, and our report will be back out on Monday. So good investing, and thank you very much for joining us this afternoon. It's goodbye from the Switzer Super Report.